BlackRock just quietly moved trillions of dollars, and almost nobody is talking about it. I'm not talking about rumors. I'm not talking about opinions or scary headlines. I am talking about trillions of real hard cash being shifted right under our noses. And this specific move signals the start of a massive wealth transfer. In this video, I am going to show you exactly where that money is going, why it is happening right this second, and how regular investors like you and me can position ourselves before this shift becomes obvious to the rest of the world. Because right now, 3 major shifts are happening in the global economy. To help you catch them, I'm going to break down 3 specific ETFs and 1 global rotation strategy that most people won't even notice until the opportunity is already gone. We need to understand the scale of what we are dealing with here. We are talking about $14 trillion in asset management. BlackRock isn't just a hedge fund. It isn't a YouTuber with a hunch. They are the largest asset manager on the entire planet. Think of it this way. If the stock market is an apartment building, BlackRock is the landlord. They own a piece of almost everything. They are in your 401k. They are in your pension. They are everywhere. So when BlackRock decides to relocate capital, they aren't guessing. I promise you, Larry Fink knows a whole lot more than we do. This move isn't based on emotion. It is based on math. It is based on policy. And it is based on probability. Here's the reality of the situation. Recently, BlackRock shifted $2 trillion of exposure out of the United States and moved it toward emerging non-US markets. That is right. They took $2 trillion out of the American economy. Now take a breath. That does not mean America is collapsing tomorrow, but it does mean that returns are rotating. Money flows like water. It always goes where it can grow the fastest. See, retail investors, that's us. We tend to react to headlines. We see the news, we get scared, we sell, or we get excited and we buy. We are reactive. But institutions, they move before the headlines are even written. They can do this because they have armies of analysts doing deep research that we just don't have access to. They have data sets that cost millions of dollars. But here's the cheat code. We don't need their data. We just have to pay attention to their hands. We have to watch what they do, not what they say. Because honestly, it is not hard to move $2 trillion if you are BlackRock. But if you don't know that money is moving, you are flying blind. By the time CNBC or Bloomberg explains this trend to you, the trend is already crowded. The profit is gone. So the question isn't, is the US market bad? The real question is, where is the new growth coming from next? Markets do not reward loyalty. They do not care if you love American stocks. Markets reward positioning. And that is why the 3 ETFs I'm going to show you are so powerful. But before we get to the tickers, I want you to really understand the math behind this. You have to hear this closely. Let's look at the numbers just for a second. Last year, the US dollar lost a significant chunk of its value. Think about that. That means your purchasing power went down. Even if your stock portfolio stayed flat, you actually lost money because your dollars buy less stuff. Investors hate that. They want to protect their buying power. So, they look for assets that give them the best return for their dollar, no matter where those assets live on a map. Let's look at the scoreboard from last year. Germany's market returned about 22%. Japan's markets returned about 26%. And the international markets as a whole returned nearly 30%. Now look at the S&P 500. It did about 16%. 16% is good. We like positive returns. It's not the dominant 30% we saw in the past, but it's okay. However, when you look outside America, you realize you might be leaving money on the table. Here is the secret sauce. When the US dollar gets weaker, foreign assets get an extra boost. We call this a tailwind. Think of it like running a race with the wind at your back. You run faster without using more energy. When you invest in foreign markets during a weak dollar cycle, you don't just earn money from the stock going up. You also earn money because the foreign currency is worth more than your dollar. It is a double return. You win twice. This is not about abandoning American stocks. Please do not sell your entire portfolio. That is not what I am saying. This is about diversification. It is about recognizing that leadership in the global economy is changing hands. I just want us to pay attention. I want us to see the wave before it crashes on us. We aren't trying to predict the future. We are just trying to stand where the money is flowing. We are just paying attention to reality. Let me be clear. America will still innovate 100%. We will still dominate tech. We will still dominate defense. We will still lead the world in AI. But capital, big money, doesn't care about past glory. It cares about future speed. And right now, money is looking for a new home. It is looking for safer pockets to hide in. Think about the political landscape. You have Donald Trump. He is a wild card to the markets. He is a bit of a joker. I'm not talking politics here. I'm talking about certainty. Markets hate uncertainty. And right now, the political climate is making people fearful. That fear pushes money out the door. It goes where growth is accelerating. not where the growth has already happened. Right now, we have a perfect storm. We have policy risk. We have currency pressure. And we have massive amounts of cash leaving the system. Last year alone, $48 billion of foreign money left the United States. Let that sink in. $48 billion. They packed their bags and left. So where did they go? And more importantly, where should you go? Here's the problem most of you face. You know you need to diversify. You want to catch these explosive gains overseas. But you don't know which country to pick. If you pick wrong, you lose. I am going to show you exactly how to solve that with a simple basket approach in just a second. But first, we have to look at the first major player in this shift. The number one ETF on our radar is VWO. This is the Vanguard Emerging Markets ETF. VWO is your passport to the world's fastest engines. It gives you exposure to China, India, Brazil, and Taiwan. Why does this matter? Demographics. These countries have young populations. Young people work. Young people spend money. Young people build things. In the US, our population is getting older. In these countries, the workforce is just getting started. Last year, VWO returned about 25%. That is a solid win. This year, the price action is a lot calmer. But for a smart investor, calm is good. Calm is a feature, not a bug. Institutions do not chase stocks when they are shooting straight up. They accumulate them when they are quiet. Think of buying VWO right now like buying the US stock market 20 years ago. It isn't a quick trade. It is long-term exposure to the next global superpowers. Now, let's look at the second ETF. This one shocks people. It is EWJ. This tracks Japan. Look at the numbers. It had a massive run recently, up 71% year-to-date at one point and returned 24% last year. Now stop. I know what you were thinking. Japan? Isn't Japan's economy dead? Isn't it stagnant? If you think that, you're wrong. You're looking at the old Japan. The new Japan is going through a massive structural reset. They are fixing their corporate governance. They are focusing on efficiency. They are finally prioritizing shareholder returns. That means making money for people like us. Plus, the yen is weak. When the yen is weak, Japanese exports become cheap for the rest of the world to buy. That is a money printer for Japanese companies. Institutions love this setup. You have a stable government. You have global brands like Toyota and Sony. And you have a currency tailwind pushing profits up. This isn't a comeback story. It is a total reset of how they do business. But maybe you don't want to bet on just one country. Maybe you want the whole buffet. That brings us to the third ETF, EM. EM is the broader emerging markets fund. It returned 34% last year. This is the tool institutions use when they want to make a macro bet. They aren't betting on just Brazil or just India. They are betting that the entire world is going to grow faster than the United States. And right now, that is a smart bet. Places like India and Singapore are growing really, really fast. If you believe global growth is about to explode, you buy EM. It spreads your risk out. Now, I need you to understand the psychology here. When you see headlines about sell-offs or Trump talking about buying Greenland or drama at Davos, do not panic. Do not start pressing buttons and selling your portfolio. People panic. Institutions reposition. See, money never really leaves the market. It just moves tables. It moves from table A to table B. Pullbacks are just the big players moving their chips to a new game. And here is the golden rule you need to write down. Every global rotation feels uncomfortable before it feels obvious. I will say that again. It feels scary right before it becomes obvious to everyone. But there is a trap, a massive mistake that 90% of investors make during a shift like this. They wait. They wait for certainty. They wait until the waters are clear and the news is good. But I'm going to tell you why waiting is the fastest way to stay poor and exactly what the smart money signal looks like right now. Here is the brutal truth. Certainty is the most expensive thing in the world. Certainty only appears when the returns are already gone. By the time the water looks clear to you, the big fish have already swam away. BlackRock isn't predicting the future. Larry Fink doesn't have a crystal ball or a time machine. He has probabilities. And that is the one thing that crushes the average investor. You are waiting for safety. You are waiting for the news to say everything is okay. But institutions, they are responding to currency shifts, policy changes, and growth data right now. If you wait for the alcohol signal, you are buying the top. Now, does this mean you should sell all your American stocks? No, absolutely not. I would never tell you to operate out of fear. This isn't about fear. It's about awareness. You don't abandon the US. You just have to find the right pockets. I told you about defense stocks. They are holding strong. I told you about rare earth minerals. They are booming. I told you about industrials. These are safe harbors. But ignoring a global rotation when the largest asset manager on earth is moving trillions of dollars, that is the real risk. You don't need to predict the future. You just need to follow the footprints in the sand. Position yourself early, stay patient, and let the system do the work. But there is another shift happening in the shadows that you need to know about. It involves gold and silver. And this is not just about the price going up. It is about a change in the rules of the game. Recently, gold and silver have been effectively reclassified. For decades, banks looked at gold like a shiny pet rock. It was nice to have, but you couldn't really use it. It was dead weight. But now, gold is being treated as a calculated Tier 1 liquid asset. Here's what that means in plain English. Big banks like JP Morgan and Goldman Sachs can now count gold as if it were 100% cash. They can use it as collateral to get loans and leverage massive amounts of money. Before, they couldn't do that. Suddenly, gold isn't just a safety net. It is a financial weapon. And guess what happens when the biggest banks in the world realize they can use gold to print more money? They buy more gold. That is why we are seeing all-time highs. It isn't just fear. It is a utility. And here's the kicker. BlackRock is in your 401k. And these moves, this gold reclassification, impact the value of your retirement, whether you own gold bars or not. This is how the game is played. They change the definitions. They move the assets, and they do it without sending you a memo. So how do we handle this? How do we stay calm when the world feels crazy? You have to understand the panic playbook. We have seen this movie before. We saw it with Trump in his first term. We know exactly how this episode ends. Notice something interesting. They always drop the bad news on the weekend. Why? Because the markets are closed. They want you to sit at home for 48 hours stewing in anxiety, reading scary tweets. They want you terrified by Monday morning, so you sell your shares cheaply. Then the market opens, a dip happens, the weekends fold, then Tuesday comes. The EU says, we will fight back. Trump says, try me. It feels like war. But then quietly by Wednesday or Thursday, you hear rumors. Negotiations are starting. Talks are productive. And what happens? The market rallies. The crisis evaporates. And the institutions that bought your panic-sold shares on Monday are laughing all the way to the bank on Friday. It is a game played entirely on your emotions. Notice that today makes the third time in a row we haven't heard a single specific detail about the legalities of these new tariffs. That is not an accident. They are keeping it vague on purpose. They want the uncertainty to linger. But if you know the playbook, you don't have to be the victim. You can be the one who profits. But there is one final piece to this puzzle. There is one specific sector that thrives on this chaos, and it's the only place I'm putting fresh cash right now. The market is designed to emotionally hijack you. It is engineered to keep you overstimulated. The algorithms, the red flashing numbers, the breaking news alerts, they are all trying to give you a traumatic experience with your money. I don't want you to look at your account, see red, feel your heart race, and then sell everything just to stop the pain. No, that is exactly what the system wants you to do. That is how wealth is transferred from your pocket to theirs. You have to resist the urge to react. Settle down. Close the app. Seriously, close it. Take a breath. Do the homework. Come back when you are focused, not when you are fearful. But knowing not to panic is only half the battle. You need to know exactly what to buy when everyone else is paralyzed. I mentioned a specific sector earlier that thrives on this exact type of global chaos. It isn't tech, and it isn't real estate. This sector historically outperforms the S&P 500 by double digits whenever geopolitical tension gets high and institutions are pouring billions into it right now. I broke down the top 3 stocks in that specific sector in this video right here. The setup is perfect, and the window to get in early is closing fast. Click this video, and I'll give you the ticker symbols.